Lesson video cover topic 4.1 Depreciation. Topic 4.1 consists of two subtopics, namely straight line method and declining balance method. By the end of this chapter, students should be able to number 1. Explain the meaning of depreciation, number 2. Explain the difference in the various depreciation methods, number 3. Compute annual depreciation, accumulated depreciation, and book value, and number 4. Construct a depreciation schedule. Assets such as machinery and vehicles depreciate in value. Companies usually dispose their assets for residual value after the useful lives of the asset have ended. Understanding depreciation method will enable us to make better decisions on disposal values. Let us assume that you buy a car. The very minute the car is driven out of the seller's premises, the car starts to lose its value. Your car loses some value each time you drive until the car stops running and has no value, or you sell the car for a residual value. This loss in the value of your car is known as depreciation. Depreciation is an accounting procedure for allocating the cost of capital assets such as buildings, machinery, tools, and vehicles over their useful life. It is important to note that depreciation amounts are estimates and no one can estimate such amount with certainty. Depreciation expenses allow firms to recapture the amount of money needed for replacement of the assets and to recover the original investments. Depreciation can also be viewed as a decline in the value of assets due to age, wear and tear, or decreasing efficiency. Many properties such as buildings, machinery, vehicles, and equipment depreciate in value as they get older. The calculation of the depreciation of an asset is important to ensure accuracy in the calculation of the tax return. Failure to make allowance for depreciation will result in overestimating the income, thus increasing tax, which in turn reduces profit. Several terms commonly used in calculation relating to depreciation are listed below. Number 1, original cost, which is denoted as C. The original cost of an asset is the amount of money paid for an asset plus any sales tax, delivery charge, installation charge, and other costs incurred. Number 2, salvage value, which is denoted as SVN. The salvage value, or also known as scrap value or trade-in value, is the value of an asset at the end of its useful life. If a company purchases a new machine and sells it for 500 at the end of its useful life, then the salvage value is 500. The salvage value of an asset is an estimate that is usually based on the previous salvage value of a similar asset. Number 3, useful life, which is denoted as N. The useful life of an asset is the life expectancy of the asset or the number of years the asset is expected to last. For example, if a company expects to use a machinery for 10 years, then its useful life is 10 years. A truck may have a useful life of 5 years, while a building may have a useful life of 90 years. Number 4, total depreciation or depreciable value. The total depreciation or the wearing value of an asset is the difference between cost and scrap value. Number 5, annual depreciation. The annual depreciation is the amount of depreciation in a year. It may or may not be equal from year to year. Number 6, accumulated depreciation, which is denoted as ADN. The accumulated depreciation is the total depreciation to date. If the depreciation for the first year is 2,000 and for the second year 1,000, then the accumulated depreciation at the end of the second year is 3,000 ringgit. Number 7, book value, which is denoted as BVN. The book value or carrying value of an asset is the value of the asset as shown in the accounting record. It is the difference between the original cost and the accumulated depreciation charged to that debt. For example, a cow which was purchased for 40,000 ringgit 2 years ago will have a book value of 34,000 if its accumulated depreciation for the 2 years is 6,000. There are 3 methods of depreciation that are commonly used. These methods are straight line method, declining balance method, and sum of year digits method. However, for Math 112, we only focus on the first 2 methods. Look at on the first method. The straight line method of computing depreciation is the simplest of the 3 methods and probably the most common method used. Under the straight line method, the total amount of depreciation is spread evenly to each accounting period throughout the useful life of the asset. The formula for finding the annual depreciation and annual rate of depreciation are given as follows. Annual depreciation is equal to total depreciation divided useful life, which is equal to C minus SVN divided N. Annual rate of depreciation is equal to annual depreciation divided total depreciation multiply 100% or 1 over useful life multiply 100%. Consider example 1. Lau company bought a lorry for 38,000. The lorry is expected to last 5 years and its salvage value at the end of 5 years is 8,000. Using the straight line method, calculate the annual depreciation, calculate the annual rate of depreciation, calculate the book value of the lorry at the end of the 3rd year. Solution: given the cost of a lorry is 38,000, useful life is 5, the salvage value at the end of 5 years is 8,000. To calculate the annual depreciation, apply the following formula. Annual depreciation equal to total depreciation, which is derived as C minus SVN divide N, where N is 5, C is 38,000, SV5 is 8,000. Therefore, annual depreciation of a lorry is 6,000. To calculate annual rate of depreciation, apply the following formula. Annual rate of depreciation is equal to annual depreciation divide total depreciation, which is derived as C minus SVN, multiply 100%, where N is 5. Annual depreciation is 6,000. Cost is 38,000. SV5 is 8,000. Therefore, annual rate of depreciation is 20%. To calculate the book value at the end of the third year, apply the following formula. BVN equal to cost minus accumulated depreciation, where accumulated depreciation can be derived as N multiply annual depreciation. Since N equal to 3, cost equal to 38,000 and annual depreciation is 6,000. Therefore, book value at the end of third year is 20,000 ringgit.